Let me now talk to you about my evolution in this. I was a lot more focused on trading, meaning looking at the charts, buying low, selling high. But then I slowly found out that it wasn't sustainable for my life because it required me to sit long hours behind the screen, often also at very unfavorable times, late at night, because depending on where I am in the world. And I know that when Tokyo opens, a lot of volume happens, the coins move. I need to be up. There's always these live feeds that you watch. So wasn't very sustainable for me. Also, 80% of traders constantly lose money. It's very hard to be profitable. Psychologically, is being in crypto is very tough. And when things happen in your life, whether that is on the personal level or in your business or in your job, you will see that making the decisions in crypto is very difficult, and you might even not make them in the first place, which was not really an option for me because that is my lifestyle. I slowly but surely understood that providing liquidity is actually you indirectly trade, because as the coin increases in value that you provide liquidity for, your size grows as well. But there's a great thing, and that is that along the way, even if the coin goes down for a while, along the way you collect those fees. So psychologically, you always have the feeling that you're getting something from it. And all of a sudden, I something shifted in my mind. So rather than looking at my crypto activities as this is the profit I make, I was looking at how if I look at this as a cash flow machine, and my money is constantly at work, and I understand that the capital at work fluctuates, which is actually healthy because it's due to the volatility that traders trade and that we collect those fees. Could I not care a little bit less about the actual coin value and more about how much does this pay me every day, and how, or every week or every month, and how much do I want it to pay me? And according to that, you can be more or less risk averse. If you provide liquidity for big coins like Bitcoin and USDC, then your return will be much smaller than if you provide liquidity for a startup coin like the AVNT that we just looked at, which that's over 7,000% right now annually, which it won't stay like that, but that's what I now do. I look at my vaults every day, and then I decide how long I keep them and how I move the money around. It becomes much more a mindset of a crypto and DeFi operator of that ecosystem rather than seeing myself as a trader. So that is essentially, I'm much happier. I've been doing this consistently for the past, I don't know exactly, but 4, 5, 6 months. And I'm much happier because I get the daily profit that I target, and I can focus on doing other things. You have to understand that we are operating in, as a liquidity provider, we're operating deep in the belly of crypto and DeFi. Most people you speak to will not understand this. Most people don't understand crypto in the first place. And if they do, then they buy crypto on a centralized exchange like Coinbase. Then what we are doing is self-custody. Why? Because self-custody lets us have more freedom in decentralized finance. So that's the next level, right? But now, by providing liquidity to decentralized finance, we're going even a level deeper. And that's why so little so few people participate, and it's absolutely like a hidden thing for most people, very abstract, and that's why you have these insane returns here. So I look at two things. The first one is volume, because we need people trading the coin so that we can collect the fees. And number two is I look at the coin's chart, because yes, the coin dropping is good because the volatility creates the fees, but I don't want to hold a coin that crashes overnight, because then my pool dies. Okay, so that's what I'm monitoring, especially with those coins that give you 7,000% annually right now. That has a lifespan that won't go like that forever. So I need to constantly monitor what does the coin do, and also a little bit what does the company that issues the coin do. So that's what I look for. The other thing that is very important is you need to, by being a liquidity provider, you put money into a pot, and then that money in the pot works. But if you want your money back, the pool needs to be liquid, right? If you are the only person who has money in there, you might get amazing returns, but when you pull the money back, it's not liquid, right? So that is also something to consider. What is my size compared to the overall size? And I can tell you that the bigger the liquidity is, the lower the return, right? Because it is less risk. So I'm going to share my screen. So if you look at the pools, and don't forget, this year is super aggressive for me, intentionally, because I only do aggressive stuff in DeFi. Remember, the portfolio allocation is have most of it in just spot holdings and just 10 to 15% in stuff like this. So look, here you can see this is what I have contributed, $5,000. This is what everyone in DexFi has contributed, $186,000. And this is what the entire world has contributed on that specific DEX. Okay, so every pool needs to be housed in a DEX, like usually Uniswap or PancakeSwap, or there's a aerodrome often for the base chain. So what is important is that you are not a whale in these pools. Here, for example, this is a less riskier pool because the liquidity is $3 million, and I seem to be almost the only one here in this. My deposit is 12K, but look, this is 0.14 daily versus 3.5 daily. So essentially, the calculation that you have to do is your capital times the daily percentage. That's your daily return. Okay, let's see what that looks like for me. So here at the top, it summarizes it. Okay, so in DexFi, I have 48.7K deposited, and that gives me an average annual API here of 4,400%. So the way I have chosen the vaults, I got the information that $144 is compounded every day, and $318 every day is taken as profit. Okay, so if you want to if you want to not be in a high risk pool, like for example, let's look at one that is really a reasonable pool. For example, CBBTC on one side. Okay, look, this is a pretty reasonable pool. Why? Because you invest in Ethereum and Bitcoin. two big players, okay? And it has 14 worldwide, 14 million liquidity in this DEX, okay? So there are multiple DEXs that may have the same pairs, but and also across chains. But yeah, so you get 0.08% daily, which in the world of liquidity provisioning is low, but it's still 29% API, which if we compare that to traditional finance, we know that is still insane. That is still very good. So the calculation you want to do is the following. Take your calculator, you say you have $1,000, and then you multiply it by 0.00. So if it was 0.1 daily, then would be this. Okay. So if I am part of a pool where I get 0.1 daily and I want $10 daily, then I know I need to invest $10,000. So you want to be on a chain that is established and in coins that are established that have high liquidity. That is lower risk. Never forget, please, that there's always, if you use a platform like DexFi, there's always the platform risk. Something could go wrong with DexFi, or like with Paka, something could go wrong with the DEX that this pool uses, right? So there's multiple layers, and the safest, if you want to provide liquidity in the safest way possible, you need to go straight to the DEX, pick a pool manually, and add the money manually.